In this film, we're going to show a common use for real-world financial modelling. We're working for a large construction company, and the government's inviting bids to build a large new hospital. A generation ago, the government would have paid the construction company just to complete the building. Under this old system, if the hospital roof leaked after 10 years, that was the taxpayer's problem because the construction company was long gone. That doesn't happen anymore. Nowadays, the construction company gets paid nothing for the initial building project. Instead, it's contracted to provide the hospital facility for the government for 20 to 30 years in exchange for a monthly rental. That rental pays not just for the cost of building the hospital, but also for maintaining it, cleaning it, providing security, and so on. Because all these are covered by a single payment each month, the rental is known as a unitary charge. This method of procurement originated in the UK, where it's known as the Private Finance Initiative. It's since been adopted in many other countries under other names. Under PFI, if the hospital roof leaks, the government stops paying part of the unitary charge until the problem's fixed. There's a much clearer incentive for the contractor to build the roof properly in the first place and to keep it well maintained. So far, we've talked about the bid being made by a large construction company. In practice, not all construction companies have the skills to provide all the services required under the contract. They go into partnership with other businesses that do have the necessary expertise. The partnership is implemented as a new company dedicated to the business of executing the contract and is owned by the construction company and various partners. Rather than employing staff directly, the special purpose company meets its obligations under the contract by placing subcontracts with various suppliers. The largest subcontract concerns the building of the hospital, which is placed with, surprise surprise, the construction company. There will also be a contract placed with a specialist in managing the facility after it's built, and that's how the maintenance and cleaning gets done. The big question that our construction company needs to answer is how much the unitary charge should be. We'd like it to be large so that we make a worthwhile return on the 20-year contract. But we aren't alone in bidding for it. If we quote a unitary charge that's too much, a competitor will undercut us and be awarded the contract instead. Bidding for the contract is time-consuming and expensive, and all that effort is wasted for unsuccessful bidders. This competitive pressure forces all the bidders to quote their best price. On the other hand, if we bid too low, we might win the contract but make no money executing it. The contract we've been talking about will run for typically 20 to 30 years. In our model, we're going to show just 4 years, so that it fits on the screen and is easy to follow. Let's put in a timeline along the top. 2010 is our construction year, and for this project we're going to have a 3-year operations period. Now, we'll deal with construction first. The upfront cost is to build the hospital, and that's a capital cost of 300 million. But already we've made a mistake. Our model is trying to estimate future cash flows to and from the project company. From its perspective, this is money paid out to the construction subcontractor. It's a cash outflow and should therefore be shown as negative. At this point, we only show one kind of cost, the capital cost of construction. Soon we'll be adding other kinds of costs, so it's convenient to gather them all together in a subtotal. The funding for the project will come primarily from a bank. Let's ask for 150 million to start with, and we'll change that later. Any difference between the cost of the project and how much the bank will lend will need to come from investors. I'm going to put in a check line as well to make sure I haven't missed anything out, and that's the sum of the whole model. The bank will charge interest on its loan. I'll show the principal and interest separately. Principal we already have. We're going to use an interest rate of 10% to start with because it's easier to check that the calculation is behaving as we intend. Construction will happen progressively throughout the year. We assume that the funding will be provided to the project by the bank and investors more or less evenly over the 12 months. The average balance during construction will be 75 million. Therefore, the interest will be 7.5 million. Who'll pay that interest during construction? Many projects roll up the interest payments into the loan, but for simplicity here, the investors will pay it, so I'll adjust the calculation. Capital costs deal with construction only. We also need to deal with operating costs, and they come in two flavours. Some costs arise pretty much evenly in each of the years, like cleaning, insurance, or security. Other costs don't crop up every year, but they can be sizable when they do happen. Examples are replacing the lifts, the roof, or the ventilation system, which we'll expect not to need to do more often than every decade or two. Also during operations, we need to pay back our debt. Initially, we'll pay back 1/3 of the debt in each of the 3 years. During the last year, we assume that the 50 million outstanding balance will be fully paid off in instalments during the year. The average balance for that year will be 25 million, and at 10% the interest will be 2.5 million. They're outflows, so they're negative. Now that we've checked the interest calculation in the first year and the last year, we can change the test interest rate from 10% to a more realistic 5%. We should do our what's left checking during operations in exactly the same way as for construction. Now what this shows are large cash shortfalls all the time during operations, and that's because the project company is meeting all these costs but doesn't have any income to meet them with. That income is the unitary charge that we introduced at the start. Before PFI, the public sector would pay the contractor once the construction was completed. With PFI, the unitary charge is paid exclusively for providing an operational facility. The project company needs to decide how much to charge the government. I'll put in 200 million. At this stage, it's an arbitrary round number and the same in each year of operations. We'll home in on a more accurate figure in a few minutes. Identifying the correct amount is one of the central purposes of the model. Now I've solved the cash shortfall problem and we have surplus cash. In practice, any surplus cash is distributed to investors in the form of a dividend. In this way, they earn the return on the investment that they need to make it worth their while participating in the project. The bank will only lend to this project if it's confident that the project will be able to service any loan, by which we mean repay the amounts borrowed and pay any interest. The bank will compare the cash available to service its loan with the cash required to service the loan. This ratio is known as the debt service cover ratio. A ratio below 1 is a sign that the project's not generating enough cash to repay the debt and interest, let alone have any left for dividends. In practice, banks require a ratio a bit higher than 1 to allow a safety margin in case things don't turn out as planned. The investors also require that the cover ratio is greater than 1 because only then will there be cash available to pay dividends. In this example, we assume that our bank insists on a ratio of at least 1.2. The investors go through a similar decision process. For them, the concern is to earn a respectable return on their investment. This is assessed using a measure known as the internal rate of return, which can be found in any finance textbook. Excel provides this with the IRR function. We apply it to the combination of the investments they contribute and the dividends they receive. The investors have a target return of 11%. If they can't earn that return from this project, then they feel they'd be better off investing in another project instead. To have the best chance of beating our competitors for this contract, we need to set our unitary charge as low as we can, so long as these two measures satisfy the bank and investors. At the moment, both measures are higher than they need to be, so there's room to reduce the unitary charge. So let's try 170 million. Well, yes, still happy. 150 million? The investors now aren't earning enough, but the bank's ratio is still alright. That's a sign that we can afford to borrow more. If we get more of the construction costs from the bank, we don't need to ask for so much from investors, and their return should improve. We'll change the loan to 210 million, 240 million, 270 million, and reduce the investment. Now neither are happy, so we must increase the unitary charge. So let's try 160 million. Now they're both happy, but there's something funny on the dividend line. Two of the numbers are negative, as they're outflows of cash to investors. But the middle one is positive. This is our model's way of representing the shortage of cash that results from the irregular cost. In practice, dividends never flow from investors to the project company. What this means is we have a cash shortfall in 2012. There are various ways to fix this. We could make the unitary charge higher in that year, but that in effect passes our cash flow problem back to our customer, the government. In general, the government prefers its contractors to shield it from such concerns. We could set aside a reserve of cash in the early cash-positive times in anticipation of the irregular cost. That's exactly what's done in real projects. But often the reserving doesn't smooth out the cash flows completely, and we need to find the means to meet the irregular costs from somewhere else. What we'll do is to sculpt the debt profile to match the irregular costs, reduce the amount we pay back to the bank in the year of the irregular cost, and we'll have to pay more back in the other years to make up for it. So let's try again. Reduce the unitary charge to 155 million. The bank's not happy, so we'll change the loan to 260 million. Keep reducing the unitary charge. 154 million, 153 million, 152 million. Right, now the investors aren't happy, but the bank is happy. Let's try increasing the loan. Now neither is happy, and that forces us to increase the unitary charge. And now I can carry on tuning this. 262, 263, no, can't do that. So on the basis of this analysis, our bid for the contract would feature a unitary charge of 153 million a year, and we'd be asking the bank for a loan of 262 million. Our model funded the hospital with bank debt and other investment. Real projects are funded in more elaborate ways, often with additional loans and various reserve accounts. Our cover ratio calculation is extremely simplified. We just show the project company's cash flow. A real model would show its profit and loss account and balance sheet too. The model is hugely simplified and it works over 4 years. A real contract will typically run for 20 to 30 years. It uses one column for each year. A real model will operate semi-annually or sometimes quarterly and be able to show the construction period monthly, and there could easily be 100 or more columns. We haven't bothered with inflation. It doesn't make much difference over 4 years, but over 30 years inflation matters very much, and its effects are carefully considered in a real model. The payments under these contracts don't arrive exactly when we show them, because the parties often take a few days to pay what they owe. The payments aren't exactly the size we show them either, because they attract VAT, which is later settled with the tax authorities. In addition, there'll be corporate taxes which we've intentionally ignored, which would require intricate modelling. Once the model was built, banks would insist on using it to perform sensitivity analysis, exploring how robust these outcomes would be if things don't go as well as we hope. These are all corners we've consciously cut to focus this demonstration on the most essential principles of pricing a bid for a public sector contract. But in spite of these simplifications, we have managed to show the competitive tension that leads bidders to quote their best possible price, the way the initial capital costs of constructing the asset are met by bank lending and investors, the need to shield the public sector customer from uneven cash flows experienced by the contractor, and how sculpting the debt repayment profile can solve this problem. The way the bank uses a cover ratio and the investors use a rate of return to assess the project, and how just 2 measures are enough to decide the unitary charge and the relative proportion of debt and equity. Our exercise has also captured the central role of a financial model in preparing and communicating a bid for a contract under deals of this nature. Such deals are structured out of many interlocking contracts, and their financial projections are the only place where the combined effect can be understood. Operis' team of experts in financial modelling, accounting, tax and finance is one of the largest specialising in financings of this kind. It develops financial models of public-private partnerships around the world. For some clients, this service forms part of general advice on structuring finance. Other clients have the expertise to advise themselves and look to buy in the modelling alone. Operis is unusual in being equally happy with either arrangement. It's the most experienced provider of financial model audits, having worked on 1/3 of the projects within the UK government's private finance initiative. It provides training. Over 1,000 people a year learn to build financial models in courses run by Operis, more than any other organisation.